Thank you, Christy. Thank you, Reed Corporate, for the invitation to come here today. I've got to talk really fast because the market is still open by the looks of it, so I'll get straight into it. Yes, we did. We announced on our ASX this morning that Strandline's flagship project, the Coburn Mineral Sands project in Western Australia, just north of Geraldton, is 75% built. So we're 3/4 of the way to our first project coming into production. We're well within the 6-month countdown now to first production and cash flow. So by Christmas, production, cash flow, so that's transformational. Those who understand mining and understand how to unlock value of mining projects would know that coming into production, and particularly 100% owning your asset like Strandline shareholders do, is really a key unlocking the value and a re-rate often. And so pretty awesome. In our own backyard in WA, the project is material on the global scale. It produces, when it comes into production, about 5 to 6% of the global zircon market. It produces about 10% of the global chloride ilmenite market, which is a titanium mineral, about 3 to 4% of the global rutile market, which is again another titanium mineral, and a little bit of rare earths as well. So quite material. And not only that, we have a pipeline of growth projects in the queue that Strandline Resources will be endeavouring to unlock over the years to come. So this is not a single project company by any means. You can sit here in 5 years' time and follow this journey. When I started 5 years ago, the company market cap was 10 to 15 million. We're now 450 million market cap, and on our way, if you believe the analysts, we're on our way to $1 billion over the next 6 months or so. So pretty exciting, and it's good to be here. Sorry about that. What I'll do is I'll start with just a bit of a corporate snapshot. ASX listed, STA is the code. We're fully funded into production with the Coburn project. In addition to that, and that project was about $340 million, and that fully funded package, and we're on track. We, being 75% complete, we've spent just under 75% of our cash in developing that. But over and above that, we have another $55 million of corporate cash. So we're really well cashed up to also accelerate our growth of our future projects. Our market cap, as I mentioned, 450 million, and that's around the 37 cents, which we are today. Our major shareholder, Tembo Capital, private equity group, based out of London. They're an 18% shareholder. They've been invested in the company for nearly 6 years, so they've really seen us unlocking that journey, and they're not going anywhere from what I understand, and they're about 18% on the register, but we have about nearly 60% of institutional investors, a lot of those in Australia, but a fair bit of liquidity as well with the retail and the high net worth that we have in our register. Critical minerals market of zircon, titanium. So we hear a lot about the critical minerals, and ours, in this case, they're used in everyday life. So zircon is used primarily in ceramics. So when global growth, urbanisation, rising living standards, and there's also a broad array of applications as well, and some emerging in electrification and also renewables, really drives the demand. And right now, the demand is really, really strong, but the key story with mineral sands is that supply is coming off, and it's creating this supply deficit. So right now we're trending in supply deficit, and looking like that's not going to change because there's just a lack of new quality projects around the world to fill that demand gap. And Strandline, through its Coburn project, but not only that, also our Tanzania growth projects, and even potentially expanding Coburn in the not too distant future, which I never thought I would think about because it's already a major mine in its own right, but expanding that potential is something that we're already studying right now. So a great supply-demand fundamental playing out for us. They're used in everyday life, as I said, ceramics for zircon, titanium in the paint pigment production, so when people are painting their houses, those sort of things that really drives the demand, which we've had a lot of that. and titanium metal, so aerospace, and then you've got the rare earths. So we have a small amount of rare earths that come out of our product in the monazite mineral that contains that key elements, and that also goes into permanent magnets in electric vehicles and LCD TV screens, etc. The valuation upside for the company. So why the analysts? And we're well covered. So we have Morgan Stockbroking, and these reports are on our website. We have Shaw & Partners, Foster Stockbroking, and also Euroz Hartley's based in WA. They've all got price targets short term over the next six to 9 months of 65 cents to 75 cents to 80 cents. So that's more than doubling our share price in this horizon, and they really want to see us transition into that steady cash flow, which we'll do. So significant valuation upside there. So I'll take a bit of a deeper dive into the project, the Coburn Mineral Sands project, and you can see there on the image we're adopting renewables from the outset. So we've got a massive solar farm that's built waiting to start to generate the power once we start to turn this on in a few months' time. This is an image of the wet concentration area. So the wet concentration plant, so very standard traditional technology, but we are using the new generation of that technology. So mineral sands, as you'll know, Iluka have been around for many years. Rio Tinto is also a major producer of mineral sands, and we're not doing anything different in this project, but we are adopting the latest technology. So we have a mine strike of about 25 kilometres from north to south, about 3 kilometres wide. And as we mine it, and our ore outcrops at surface on the eastern part of the deposit, then goes undercover a little bit, at a really low strip ratio generally. As we mine it, we gradually backfill, and then we recontour to the previous landform that we prior to mining, and then we reseed it and fully rehabilitate it. So essentially, we're going to be closing the mine as we strip mine from north to south in our case. It is a 40-year project, Coburn. So it's a generational project. And high margins, so we sit in the best part of the cost curve, the revenue to cost ratio. So you talk about gold projects that have, 400 ounce or $400 an ounce sort of margin. Our margins are significant. So our EBITDA margin's about 55% or above. So and we sit in the best part of the cost curve there. We'll be spinning off about at least 104 million EBITDA year on year for that next 30 to 40 years. If I apply today's pricing, it's about 35 to 40% above what our DFS numbers were when we studied it a few years ago. So that's really good timing for us in this market right now to be coming into production when the pricing's about 10-year highs right now. So the last time it saw these pricings was back in 2011-12. So great time for Strandline to be coming into the market. We've pre-sold all our product already for the first 5 years, so 100% of our offtake, and I'll take you a little bit into the offtake, and there's a real differentiator for Strandline in that story. Here's the mineral separation plant. So this will be separating our mineral into their final product on our site north of Geraldton there, and we're as it says, we're adopting that renewables from the outset. So 31 to 35% of our energy from day one will be via solar, and the rest will be LNG engines combined with the solar. And then once we get into production and we reach that steady state, and being an electrical background, which is really exciting, we'll be adding a few wind turbines, which will take us to potentially 60 to 65% renewables, which is essentially the industry benchmark of where we want to take that industry. So right from the outset, that's where we'll be targeting, and it's getting built. So quite exciting. The cash flows, this is the cash flow, sort of, you can see the revenue line. That was the DFS numbers. We're about 35 to 40% higher than that on our revenue line. We've already locked in about 65% of our operating costs on or below the DFS budget. So we're de-risking our operating costs progressively. The last 30 to 35% of operating costs is exposed to labour market, which has escalated a little bit, but it's offset by some of the more favourable contracts that we've already put in place for our mining, our power, our logistics, etc. One of the key things to understand is our funding package. Being a Tier 1 project in a Tier 1 jurisdiction, we've been able to attract really good quality funding package. The Northern Australian Infrastructure Facility, which is the Commonwealth Government of Australia, so the Federal Government of Australia, are our major lender. What's their criteria? It's, I guess, longevity of the project, critical minerals, strong environmental and Indigenous engagement, also use of existing infrastructure, and being 2 to 3 hours north of Geraldton, we're able to really utilise the latent capacity in the Geraldton port, where Iluka have been operating in and out of for the last 40 years. One of the key things with the NAIF tranche is that it's a 15-year tenor. Normally a senior project financing, you'd probably get it over a 4 to 5 year tenor, and you'd have to pay all that debt back in that period, and you wouldn't be able to distribute cash. You'd be basically locked up while you're paying back debt. However, with us, is that we have a relaxation of that. So we have that long tenor. We don't make our first scheduled repayment of the NAIF tranche until the start of year 8. So it's really quite a strong repayment holiday, if you like. We have a smaller bond tranche that sits alongside it, which we pay back early. But I guess as planned, we'll come into production in December quarter. All of next year we'll just be building cash in the business. And then in March quarter 2024, so 15 months from when we come into production, we'll be able to distribute up to 70% of our excess cash within Strandline. So that provides shareholders not only the capital growth of what we're coming into, but also potential distributions earlier than what you would normally have for a greenfield project such as ours. So it's just an important nuance of our funding which differentiates us going forward. As I said before, it's all conventional. So nothing that we're doing is new. Where does are pushing the sand, it's really free-flowing sand. So those technical boffins in the room, in our case, we have a really coarse mineral. We have low slimes. We have limited induration in the deposit. So it's a relatively benign mining method and very proven mining method. We draw the water from the large aquifer that resides under the ore body. We put the sand into a slurry and we pump it to the wet concentration plant. And that just separates via gravity separation and screens, etc., to produce the heavy mineral concentrate. And then we'll sell a few shipments of that, and then we build up the inventory to put it through the mineral separation plant. This is our offtake strategy. We've got 6 major offtakes. One key thing to note is that 80% of our revenue will be linked to America and Europe, and 20% will be China. Typical in mineral sands, if you have a look at Iluka or some of the other mineral sands producers at the moment, they're very biased to the Chinese market for their sales. We've been able to, through the quality of our mineral, we've been able to tap into the big markets in Europe and America, and the high-end markets. Higher price, higher-end mineral, cleaner mineral, less waste. It's all that sort of stuff. So we're lucky that the mineral allows us to do so. So I won't go into Tanzania so much, but look, this is a business in itself over and above the Coburn business. We signed a strategic joint venture agreement with the Tanzanian government in December. We've got a pipeline of projects there. I'm heading to Tanzania next week with our chair also and some of our team. Really exciting growth pipeline. And Tanzania is a little bit like WA, a really strong mining jurisdiction. It's getting back on its feet as it went through its mining reform, and we've got some significant upside for shareholders over time. So just to wrap up, there's a lot going for Strandline. Pretty exciting times over the next 6 months. We feel we're in the right commodity. We've pre-sold all our products. We're going about things a really sustainable way, where we've got the beauty that this is a new mine, it's a new business, so we don't have to inherit any bad behaviours or bad mining methods previously. This is new, state of the art, and a great story to follow going forward. So thanks for your time. Really appreciate it.
Thanks, Lou.